Markets don't move randomly. They move towards liquidity. And one of the biggest pools of liquidity is your stop loss. So where does liquidity naturally hide? Not randomly, because retail traders are predictable. They place their stops in the same obvious places. Below yesterday's low, above yesterday's high, top of an order block, behind support and resistance. Thousands of traders looking at the same chart, making the same decision. So that's no longer just a collection of stop losses. It's a pool of liquidity, a stop loss cluster. And that's exactly where price is often drawn. So now you know where liquidity hides. But why does price go there? Because large orders need liquidity. Institutions, funds, or market makers can't always enter at a single price. They need willing buyers and willing sellers. And those stop loss clusters provide exactly that. When price sweeps those levels, stops become market orders. Liquidity appears. Large positions can be filled. One side is forced out, the others get in. That's not the signal, that's the setup. This is where most traders get it wrong. They see the sweep, they see price blast through a level, and they jump in, long after the low, short after the high, chasing the move, and then price reverses, right back through their entry, because the sweep was never the signal. It created the conditions for the move. The market needed that liquidity first. Now it has it. But that still doesn't mean it's ready. So what do you actually wait for? Let me show you what this looks like. Price has been trending down and retail stops are sitting right above this high. Watch what happens. Price sweeps the level, stops trigger, everyone panics. And then it goes down to the level you wanted in the first place. It looks like a breakdown, but it isn't. Price stalls, then reverses. Everyone who just gets stopped out watches the market move exactly where they wanted, and without them. That's the trap. So how do you avoid it? A professional trader once said something, and it really stuck with me. Do your trade setup as normal. However, then move your entry to where your stop would have been. You'd be surprised how often price goes there first. Let's check it out. It swept where you had your original stop loss. It moved right above it. Did a sweep, you'd have been in and gone straight down to your profit target. Think about what that means. The level you are trying to protect is often the level the market needs to visit before it moves in the direction. So next time you set a stop loss, ask yourself one question. What if this isn't where I get out, but where I get in? Because if that's where you'd put your stop, so would thousands of other traders. And that's where the liquidity is. Why do most traders enter too early? Most traders see the sweep and think they've cracked it. Price hunts the high and they buy. Then they sweep again and again and again until they get your stop loss. Because seeing the sweep is not enough. The market doesn't owe you a reversal just because liquidity was taken. It owes you nothing. So why do traders jump in early? Because waiting is uncomfortable. Patience is difficult, and FOMO gets you. The candle is moving and the move feels like it's disappearing without you. So they act before the market has shown its hand. And that's the mistake. The sweep gets your attention. The reaction earns your trade. And to read that reaction, you need to know what you're looking for. Before we go any further, let's be honest about something. Not every sweep reverses. Sometimes price sweeps a level and keeps going. The liquidity gets taken, the trend continues. No stall, no reversal, just continuation. So how do you tell the difference? You don't. Not at the sweep. That's the whole point. Anyone telling you a sweep always means a reversal is just selling BS and what they claim as certainty. The sweep is context. It tells you where the liquidity was. It does not tell you what happens next. Only one thing does, and that's what we're going to look at next. So what do we actually wait for? Two things, a market structure shift and a break of structure. The sweep gave us context and now we need evidence. The market structure shift is the sign that something has changed. The market stops doing what it was doing, but one shift isn't enough. Markets don't reverse on a single candle, so we wait. Now we have a market structure shift in the direction we were planning. We still wait. And that's why we waited. We wanted a break of structure to the downside. We didn't get one. We got a market structure shift again to the upside, followed by a break of structure to the upside. So once it was confirmed after, say, this candle, you can plan a long. If I wind back to after this break of structure is confirmed here and another candle confirmed it, I could set a long position. Not going to worry too much about my stop loss setup for this example. And let's just kick it up there. And there we have it. So the sweep showed us where the liquidity was. The market structure shift got our attention. The break of structure earned our trade. Only then do we consider an entry, and not before. So that's the theory, but how do I apply it? Well, I don't sit in front of hundreds of charts every day. As well as being a trader, I'm a software engineer, so I wrote software to do it. Pulseflow scans 410 trading pairs every 15 minutes. And if we look at PIBX here, yesterday is the example. PIBX came in as an alert. You can stop the video and check out what we give. But it gave a bearish alert. If you look at this sweep, it's saying to you, go long. I still apply all the rules I've just been through, as well as the others you will find in my other videos. But as you can see, the alert got my interest without me having to look at 100 charts. I came to the charts, saw that this wasn't a long, it's in a downtrend. It's a bearish alert. You can see that here. So I was looking for a short. And when I came here, market structure, break of structure, that's the point. I'd be looking to take this trade. And that is 1 day later. Patience, patience, patience. That's why we use TradingView. We can set alerts. We can come back periodically and check it out. We've all been on the wrong side of liquidity sweeps, but now you know why. The sweep creates the conditions. Market structure shift in your direction gets your attention, and the break of structure earns your trade. Stop feeding liquidity. Start reading it. If that helped you, will you please subscribe, like and share. You can watch one of my other videos down here, a liquidity related video also. And I will see you in the next one. Bye bye.